welcome back to our special Austin series being filmed here at Artemis Capitol. Right now we're going to be joined by Ted Oakley, a man I greatly admire. He's a longtime reader of my research, but that's not why I admire him. He's managing partner and founder of Oxbow Capital here in Austin. Thank you for taking the time today. We're switching roles a bit.
Thanks, Danielle, because I'm usually interviewing you.
Yeah, that's true. But Down the Middle has a kind of a mission. We were talking before we started filming of trying to convey to younger workers, just entering the workforce, what people's stories can be and where they can come from and become accomplished, successful people who I would love to have on Down the Middle. So you have a story. In fact, you call it your story.
I do. I do have a story. I mean, it's not, I don't think it's, I think there's a lot of people really that have a story, and so I always love reading their stories about how I read your story.
Yeah.
And so I always love reading about them and what they have to say, about their life and how they overcame things.
Yeah.
It helps me.
So what was your beginning? Where were you born?
Well, I was born in a little place called Decoy, Georgia, for lack of a better place to give you from a geographic. It's about 30 miles from where Deliverance was filmed. But I don't want to say that disparagingly, by the way, but kind of telling you, way up in the mountains. And I had we were poor. We just didn't, there was no money. And so we ended up, we really had, outside water. We didn't have indoor, we had outdoor plumbing. I mean, it was that kind of thing,
Sure.
So you didn't have any money, so you had to, I started working when I was 6 years old. But that's what you do.
It is what you do. I started working when I was 12.
Yeah.
So, I mean, we do what we do. So how did you, clearly we're in Austin, Texas now. You've been to Dallas, you've been to New York, you've been in the Army. What was your journey out of the mountains? How did that begin?
Well, my father was a minister, and he wanted to, decided he wanted to do somewhat of a missionary approach to a lot of the sugar beet workers in northern Colorado, and Greeley and up in that area. And so we went there, and it was we basically lived in the ghetto, but it was it was an experience for sure. And I worked there too. And we ended up, he was a Texan, so he always wanted to come back to Texas. So he worked around different churches and ended up in East Texas. And that's where I left home when I was 8. As soon as I got out of high school, I left home. And I don't want to say that's not a negative on any religion or anything like that. It's just,
Sure.
It wasn't for me. And so I went on to leave. And of course I was in the Army a couple of years, and then I ended up, I worked 40 hours a week to go to college. So, but you know what? A lot of people do that, and that's why I'm saying it's not so unusual. But my thing.
It's more unusual today than it was back. I mean, yeah. I think financial aid has changed how students behave and changed how students approach paying for college.
100%. Nobody knows this, but I would go down to a banker and borrow the money for books and tuition, and then I'd pay it back over the semester because I was working.
Right.
And I'd do the same thing the next semester. So that's
kind of like
how it worked.
A layaway plan for your undergrad.
Yeah, but it worked, and I would have loved to have studied more and do a thing, but when you have to make it, you have to make it. Right. You can't do all the other things. And so that's how that all happened. And really, I've been very fortunate along the way. People have helped me. That's why I ended up on Wall Street in 1976. And I wasn't an Ivy Leaguer.
1976, okay.
Yeah, I wasn't an Ivy Leaguer. I was sort of, you know how it is. I mean,
I do know how it is to be on Wall Street without being an Ivy Leaguer.
Yeah.
It's not a lot of fun.
Yeah, and so,
especially if you've got a little bit of an accent.
yeah, and when you go into the room with people, if everybody in there is, Harvard and Columbia and Yale and everything else, and Stanford, then you're like, but I know as much as you know if you'll just give me a chance.
Exactly.
So but I've also been fortunate that so many people helped me along the way.
Mm-hmm.
That's important.
Do you have any particular mentors who kind of guided your early career?
You know, I had a fella, and when I was in high school, I worked all the time too.
Mm-hmm.
And I had a fellow there that helped me get my sights straight. His wife was a teacher, and he said, hey, you can do this, okay? You can go on to school and you do what you want to do. He was fantastic, and he really helped me. I didn't see him after I left.
Mm-hmm.
I saw him one or two times, but then I had another gentleman who was the greatest guy in the world, who was really more like a dad to me, and he had double degrees from Oklahoma and Texas, law degree. It was everything. And interesting enough, he was just an investor at home, did all of his own investing, and worth a lot of money.
Before day trading was a thing.
Never had a credit card.
Gotta love
Never
that.
had any debt.
God.
Drove the same car. He had one of those, remember the Cougar?
Oh my gosh,
Kind of
yes.
this old Cougar. He had an old Cougar that he had like 180,000 miles on. But he taught me a lot about just the basic, debt, what you want to do.
I mean, these are all. I mean the whole, financial literacy in this country is vacant. It's gone.
Totally.
They don't teach you. People don't know the idea of having a budget. We don't have checkbooks anymore. You just have a debit card, and
Yeah.
it's interesting how times have changed. But 1976. So Jimmy Carter's in office. Inflation's flying high.
Right.
And Paul Volcker comes in to the Federal Reserve.
Right.
So what was that like to be witness to the rise of such an important and disciplined Fed chair?
Well, you have to remember that between 1966 and really August of '82,
Mm-hmm.
We had a period where the market would just trade between 1,000 and 750. So for a young guy on Wall Street, I thought that's what it did.
Stayed in a range.
You buy it at 750 or 800, and you got to get out of some of it at 1,000 or 1,050. So then comes along Volcker, and he's really pressing it. And of course, if you bought any bonds during that period, by the time you got to settlement date, which was then a week,
Mm-hmm.
they were already down in price.
Yep.
And so you get into that kind of thing, and that's how you get sort of raised. And then along comes Henry Coffman in August of '82.
Mm-hmm.
And of course, the great Solomon Brothers call, anyway, so the market takes off, and by '83, '84, we're up there. And so people like me have been around already a few years are like, did we go over 1,000?
And stay there?
Yeah.
Did we hold that level?
We did. And
Of course, the
and
price to earnings ratio was
Yeah.
a single digit. I mean, you were witness to, well, actually, you were witness to the last time the PE on the S&P was a single digit.
That's right. And my hat's off to a fellow that works for me today who was head of research for 3 or 4 big firms on Wall Street, and he's 87 years old. And he called that for me and said, hey, by the way, things are changing. So I see people have helped me all along the way.
Sure.
He's still with our firm today because I hired him out of when he retired.
That's fabulous.
And so
And he's still cranking along.
he is, and he's in great health. He's in Houston, and he's just one of my good friends too.
That's. I mean, I'll tell you a funny story. I'll digress for a minute. There was a gentleman by the name of Stan Nobby at DLJ when I first started, and he said, "You don't exit a bear market on the S&P 500 until you hit a single-digit price-to-earnings ratio."
Interesting.
And I'm still waiting.
You're waiting.
I'm
Yeah.
still waiting.
Well, and see, whatever era you grow up in, you have to be able to adjust and really think differently all the
Right.
way.
I remember the gas lines in the 1970s. I mean, I was in the backseat of a
Exactly.
car, but I remember.
Yeah.
I remember it was pretty hot in San Antonio with the windows rolled down in the summertime in those
Yeah.
lines. I mean, these are just the memories that you have growing up. But people, I don't think investors, I don't think anybody has any
Yeah.
concept of a market that goes anywhere but up.
What's interesting in San Antonio, because you'll remember this, in addition to working all during the week, I was still in high school, on the weekends, I would leave at 11 o'clock at night and drive with a whole truck full of roses, San Antonio, Texas.
Tyler, Texas, Tyler roses.
And we would sell them on the corner, and we'd make a lot of money. And then we'd get back real, like we'd drive, then we'd pick them up and then drive all night, get back to East Texas, like, 3 or 4 o'clock in the morning. But man, we'd make a lot of money because they bought those roses in San Antonio.
San Antonio loves roses.
Yeah.
San Antonio rose. And I haven't been back to San Antonio in so long. I hear great things.
Yeah.
If I had the chance, I come here. So what happened after New York? Well, first of all, were you actually on Wall Street on October the 19th, 1987? No,
I was working in a firm, but by that time I came back to Dallas by then.
Okay.
And actually, I had, at that point in time, there was a firm, two things had happened. We had I left Merrill Lynch because we had a great private company called Rotan Mosle.
Mm-hmm.
And we sold that company in 1983 to Payne Webber.
Uh-huh.
And
Payne Webber, wow.
Yeah, so one name from the past. And so over the course of my two partners now and another company started, and it was HBO was that company, and I knew things were expensive then. I mean, in fact, we did a study in August of '87, and I had everybody go back and say, well, if you've made 24% by the middle of the year, okay, what are the odds of you getting a lot more than that by the end of the year? Mm-hmm. And it was like 2 out of 50 or 2 out of 40 or something. It was a number where I looked at and said, fellas, we need to raise some cash. So and
August the 12th, of course, that was Greenspan's first day on the job.
Exactly. And and so we had about 40% liquid, just for that reason. We thought, well, we're not brainchilds or something. It's really just the way it worked out. And we thought things were expensive though too at the time, not compared to what they are today, but they were. And then Greenspan comes in, and he decides, as I mentioned to you earlier, he's going to be another Paul Volcker, which he's not.
Kind of the opposite, yes.
And he raises the rates. And so he gets the bond, short bonds, 5-7 years, like up to 10%.
Gosh.
And so all the money managers say, hey, by the way, I'll take that and you can take this. And so they sell their stocks.
That's trade.
And between Friday and Monday, we're down 35%.
And Alan Greenspan on Black Monday was in Dallas, Texas.
Was he really?
He was. He was there for a big economic symposium where he was supposed to be the keynote on October the 20th, but he never made it to the podium.
All right.
He flew right back to Washington, D.C.
Okay.
And that was kind of when the Fed put was born. But that era, that Greenspan era, you saw the changing of the guard at the Federal Reserve. You saw the world go from rational to irrational.
Right.
God, I just said irrational, and he said irrational exuberance in 1996.
He did. That was his deal.
Was it a subtle change in the beginning?
Well, my problem with Greenspan and really everybody else since him is that I never believed them. They would say one thing and then they would do something else. And every time something got the least, and I knew what was happening. We had such, pardon my word, but we had such a lousy Congress, really, from that point on and all the way till now, that
Same people.
They shirked, same people.
The same people.
They shirked all their fiscal responsibility. What you should get in government is Congress does a fiscal policy that helps the Fed so they don't have to get in there and do everything.
Right. And it was during the Carter administration, when you were in New York, that they gave the Fed the dual mandate, the second employment mandate.
Exactly. So they did the wrong thing. In other words, they ended up in a situation where all of a sudden you're in a situation where Congress is like, you know what, you take care of that.
Yeah, you do it. Yeah.
Well, that's a bad thing when the only thing you have to do it with is money. You can't do, I've always said, in all these last 20 years, I've said, you want to give somebody some incentive? Tell somebody else. Tell me as a business person, okay, you hire somebody, but it's got to be $75,000 a year or higher, or 80, or whatever the number is, and I will give you a tax credit for that, by the way. Or if you do, try to incent the thing so you can take the average person out here and bring them up.
Of course.
Well, all of ours, they keep them down.
Absolutely, and we're we continue to kind of go in the wrong, maybe some moderation is being introduced.
But to answer your question, I saw that, and you saw it between the Fed and the Congress, and it just kept on going, and now now we have the Fed, Congress, and Wall Street.
We're not going to go there quite yet.
Okay.
We're not going to go there quite yet. Instead, let's go to Tokyo.
Oh, yeah.
In 1989.
Yeah, we lost business in '89. We talked to people. I remember I would, I wasn't that old then, but I knew that they were expensive because everything there was 80 or 100 times earnings, and some much more than that. But
that people don't realize, the NASDAQ bubble popped. The S&P 500 PE was like 44.
Right.
In 1989 in Japan, it was 99.
Exactly.
I'm like 99. I mean, so people are always like, well, bubbles can keep inflating. I'm like, apparently.
And so we would get, I wouldn't say we get run out of people's office, but we got fired some because they said, hey, you don't own Japan. So it's a little like, we won't get into this, but it's a little like crypto and NFTs now. But I mean, the same thing,
Yep.
And so they would be like, well, if you don't own Japan, then we don't have a place for you. And so, well, okay. Well, that worked out okay because here we're sitting today and you never made any money.
Right, no. I mean, that's, we keep counting the lost decades. It's kind of like University of Texas football.
It's getting better, though.
How many lost decades?
Danielle, it's getting better. It's getting better. We have a good coach.
Keep the faith.
Right.
Keep the faith. I'm trying. Every time I look to my left, I see Memorial Stadium, and it upsets me after this last season.
It'll do better. It'll get better.
I'm going to take your word for that. Fast forward 10 years. You got more flack in 1999.
Oh yeah, there was a thing going. There was a term going around in between about 1997 and 2000. We do a lot of work all over the country, so we especially do a lot in California, and of course that was the Silicon Valley push. And so these people would say, "Hey, Ted, we have a new paradigm." I've heard that word. I can't tell you how many times.
It's different this time.
Yeah, it's a new paradigm. And so I would have these people that would have $50, $100 million in stock options, non-qualified. They would sell it, and I would say to them, "Hey, you might want to cash some." They would cash them in, but they wouldn't sell it. And I'd say, "Well, you might want to sell some of that because the IRS will be here next year, okay?" Mm-hmm. And they're like, "No, new paradigm."
Yeah.
And so by the time we got into the end of 2000, and a lot of those had just crashed. I had numbers of those people that could have walked away with $50 million net worth, zero, and they owed the IRS loan.
Oh.
So I never went back to them and said, "How's that new paradigm working out for you, really?"
Of course.
I wanted to. But that's what happens in those kinds of periods when greed takes over, like it is right now. Mm-hmm. You can't sober people up. They're like, the greed is just too much of a push. And that's what happened then. We had a really good investing period between 2000 and 2003. Mm-hmm. And not because we're the greatest investors in the world, but because we had enough liquidity.
You had dry powder.
And we had some fixed income. Mm-hmm. And we could see that it was so crazy that I remember a bet with a mutual fund manager that said, I said, "Hey, when the NASDAQ was at the high," I said, "Well, it's going to break down at least 25%. I'll bet you dinner on that."
Yeah.
He said, "Okay." Well, when it broke 25, I said, "Tell you what, I'll bet you another dinner that goes down another 20 points." And he's like, "Man, I've got this one."
Oh boy.
So it's those
80% later.
Yeah, there you go. Got it.
Speaking of high multiples, and speaking of dry powder, which I just mentioned, if you look out the window, you see lots of cranes, and Austin's not unique.
Oh, no.
And there's still building going on in places like New York City today. Talk about some of the parallels that you are starting to sense in the commercial real estate arena, and how commercial real estate is related, unlike prior cycles, to residential, like it's never been before.
Well, it's a good point. And by the way, you write, I'm trying to plug you here because you write so many great things about that. Yep. And the piece you did yesterday was off the charts, by the way. But you're right on the money. And what happens is people have an idea, over the years, they have this idea that you can't lose money in real estate. Of course, I always want
It's a hard asset.
I always want to say,
Diversification vehicle.
Yeah. Do you know this particular symbol, RTC? Do you remember? And they won't know what that means, But I'm saying, if you know that, then you'll know what can happen with real estate. And so, what happens now is, and this is what I see now, is that everybody has done so well with it, and the money has pushed it so far that nobody is listening to anybody. They are going, okay, I'm going to build more houses. We're going to put more big buildings up out here. It's 25% full, but it'll be okay. We get offered things all the time on the real estate side. I had one 3 or 4 weeks ago that said, hey, got this great office building, when we have one tenant that's at 75% of the lease, but they're moving. I said, well, you already bought it? Yeah. I said, well, what are you going to do when they move? You got a 75, what if you don't leave? See, that's the kind of thing that's going on right now. And so what happens is you end up with this situation where people have had it good for so long, and every time something happens, of course, here comes your Fed, one of the best analysts I have and runs, he's our chief investment officer, said this the other day, that the stock market has become the savings account for the Federal Reserve for individuals. And that's rolled over to a degree in real estate as well. So you have all these things, and it's been so easy. Again, I hate to talk about this, but it's been so easy. Then why would I want to worry about doing valuation looks and trying to do my work on something when I can buy companies at 10 times revenue, SPACs, NFTs, cryptos, and they all go up anyway. Why would I do the other? Yep. That's where we are today.
That is where we are today. But we're not going to go there yet.
Yeah.
We're not going to go there quite yet. Let's go instead to the last time we had real disruption in the corporate bond market.
Right.
So this is 05, 06, 07. 07, I think junk bond spreads hit their all-time low. They're lower today if you adjust for yield.
Oh, yeah.
Junk bonds are even, they're yielding negative, for
right.
heaven's sake. But what was that Bernanke era like prior to QE?
Well, I always felt like these Fed presidents wanted to sort of be the new Messiah. They wanted to be the one that says, I got this, okay? And Bernanke started out that way too.
Yeah.
He'd written that paper on helicopter money and all that sort of thing.
Oh yeah.
So what happened is you could sort of see it coming, and they completely brushed off the subprime thing. They were warned.
It's contained.
Yeah.
And you've got Janet Yellen out in the San Francisco Fed with Countrywide in her backyard.
Exactly.
Just clueless.
And so
that would be Madam Treasury Secretary. Sorry.
Exactly. And so that's how it started in there, and you knew you could tell what was going to happen, and so they were like, okay, I've got this, and it all was born out. I think this whole thing was born out of his research that he had done on the Depression. I think where we are today came from that, okay? To that, you know what? We know what happened then. They didn't really have enough money, so you need to flood it.
That was his thesis.
And we can fix it.
Right.
Right. And so what happened is that's what they did. That's what he started doing, and then everybody else followed suit. But it was always interesting that I've never had any Fed president own it. Oh. You can go back and say, hey, you made this error. Nobody ever owns it.
There is no accountability at the Fed.
By the way, in the money management business, you have to own it.
Of course you do.
Because somebody's going to say, well, what happened on that one?
That's right.
So you get into that sort of thing with people. Yeah.
Well, I think that we might have had the notion. In fact, it was here in Austin, Texas, when I ran into Richard Fisher. I was here for a UT game, so it must have been the fall of 2015.
And you weren't working for him? You were just met him.
We'd both just retired.
Another later
finished
on.
I just finished working for him for 9 years. It was plenty of time working for him. But we ran into each other in the lobby of the Driscoll Hotel. And this is the fall of 2015. So he's been retired a few months from the Fed. I've been retired a few months from the Fed. And he said, well, sit down for a second, Dan. I said, okay. He said, I want you to pay attention to one person and only one person. There's only one person who's pushing back against Bill Dudley and the others who want to keep reinvesting and maintain the size of the balance sheet. He's really got fiscal discipline, and he's just like me. He's not a PhD in economics. So pay attention to this guy named Jay Powell. Good friend of mine. He used to read your briefs, Danielle. He knows your work. I'm like, okay, but it's kind of hard to pay attention to somebody who doesn't say anything.
Yeah.
Because he was just a very quiet Federal Reserve governor when he was a governor. And he just quietly continued to push back against all this craziness until he got to office.
Yeah. You ever seen the movies where they reprogram the brain, and then the person jumps up and they can go different? Yeah.
Well,
right.
but this goes back to your point about Bernanke and the Great Depression.
Right.
And how they addressed the aftermath of the subprime crisis.
Yeah, right.
And now we see it in corporate credit.
Totally. Right. You're right.
So, I mean, in a way, Powell was stuck.
He was between a rock and a hard place, the way it came about, right. And we became too dependent on the stock market. It's flipped now. Used to be, the economy would be great and then the stock market. And now, you know what it is. You write about it.
Yeah.
It's that way. It's flipped.
So where do we go from here?
Well, we think that we're in a period a lot like the 40s where, I've got this two graphs I put together that show the 90-day Treasury bill, and it stayed at basically 1 to 1.25 for 1940 to 1954. And then you saw the price indexes, consumer price index, they just kept right on going. Mm-hmm. And they never slowed down. It's interesting to us because I've looked at a lot of different periods, and we didn't think we were going to go back like the period I was in where you had, 18% prime or something, that kind of thing. We felt like it'd be more like that, which then they didn't have to own it. They could say, you know what, we're just going to keep the rates low, and we're still going to inflate some number. Maybe it's like your friend and my friend Jim Bianco says it maybe just be 5 or 4.5, 5, 6. It doesn't make any difference. If you're only getting 1, you're going backwards. And so what happened is, I think that's where we are on that part of it. And I also think what that's going to do is probably put you in a position to where the stock market is going to be like it was. Most people want to realize this, between January 1 of 2000, it took you until 2012 to break even.
Wow.
Now, nobody's going to tell you that.
12 years.
Because all they're thinking about now is, look at the last 10 years, and they show, when you go in and look at numbers, this is my 3-year, this is my 5-year, this is my 10-year.
Of course.
And I'm like, well, wait a minute. I can show you 1966 to 83, and I can show you General Motors and Sears and all those big stocks.
Oh, yeah.
No splits, same price.
Yeah.
And so, and then when you get into that with people like Cisco Systems, dream stock of the 90s, late 90s, 82 high in March of 2000. Oh. 82 to 8. And it's still today, it's not back. See, it's like Japan. So I think you're going to get into that where you go through a period, and here's the problem with most people in the business. When you go through a market that just does waves, if you don't know something about putting money to work lower and taking money off when things are more expensive, you're going to get buried. And the reason you are, and this is why I think it'll be this way, the entire industry today is built around 60-40 or ETFs, index funds, and it's basically what I call a plug-and-play market. We're going to plug you in, and we have all these people that, like I mentioned before, that are wealth advisors that have no wealth. So they just plug you in and expect, 10 years later, you'll be okay, don't worry about it. And it's interesting, we do.
And they do tend to, they're kind of cookie cutter. It's a generic.
All the same. I could bring 20 in and they all look alike and they'll all say the same things. And give you an example, 90% of our business across 30 states comes from people that sell a company. And they get a lot of money.
Oh, yeah.
And it's interesting
Money
because,
in motion.
and
I
so
remember
they'll say, exactly, or death or divorce. You've got it.
Yes.
Yeah. And so they'll say something like, well, I'm talking, everybody I've seen here says, just do the 60-40 and, over 10 years, let me show you the last 10 years, 5 years, they get at that thing. And I wrote a piece about a year ago that was entitled, There Is No 40. Because there isn't.
Yep.
So I'm saying, wait a minute. So I can show you all these bonds out here, and like this year, every bond fund's down.
Yeah.
Now our conservative accounts, which have some bonds in there that are legacy from a long way back, but they're up for the year. Not a ton, but they're not down.
Right.
And so what happens is people, I think that's what we'll go through. And I think it'll be a long drawn out affair, and you'll end up with people in a position where they say, you know what? I'm paying you 1% a year or whatever number that you want to pull out of the air, 3/4, and I haven't made any money in the last 6 or 7 years. Okay?
Yep.
And
Flat as
so
pancake.
you made more money than I have.
Yeah.
That's what happens in these periods, because that's what happened between 2000 and 12. We got a lot of business.
But if you're talking about markets stuck in a range like that, passive doesn't work.
Doesn't work. And you have to have liquidity. If you look at the two biggest years we ever had, really, three. It was 87, 03, and 09. Not because we're geniuses. By the way, Danielle, really it's not, we're not bragging on it. It's just because you had to have the sense to have an insurance policy, at least have some liquidity. I wrote a book, written a number of books. One of the books I wrote was called The Psychology of Staying Rich. And the point of it was, and I interviewed a number of billionaires, and everyone to a number would say, I'd find out that they had on average about 35% liquid all the time.
All the time.
And if you ask them the question, why is that? And they say, because I want to be around because things are going to get bad and cheap, and then that's when I just clean up. They're all the same. Then you go out here to somebody that only has $5 million. No cash.
No cash.
Okay? And I always say to them, you want to learn something Warren Buffett just 2 weeks ago just announced the most cash he's ever had on the books. Okay?
That's saying something.
Yeah, wake up. There's a reason really good people know how to have a balance. And I think that's where we're headed. I think people, I see people talk to me. We don't do business with them. They're 80 years old. How much you have in the market? Oh, I'm about 90%.
Oh, gosh.
I'm like, well, I know, but you're 80. So you gotta, that's where we are today, though. And that's what I think, the way I think it'll play out will be that way.
What are Jay Powell's options?
He doesn't have many. I think what happens is that they're going to job on it, like all about that, and and it was like the 15 billion thing. I'm thinking, okay, everybody thought you were going to do 20 or 25 billion, cut back. You do 15 just to say, well, we're done. They're doing that thing. And one of these days, I think they'll get in a position where I don't. One of the things I know about this business, and that's why I'm extremely humble, is because I've been humbled many times, okay? And if you get arrogant in this business, you will get murdered. And so I'm always looking around to think, okay, what am I missing here? Because a lot of people think, well, he's going to have to raise rates, we're going to inflate. We might not. It might just be Dullsville, and they can't get anything going either way, but it has to do with if they're going to really take away the buys. Not for me, it's not so much the raising of the rates, but I don't even know if they have the guts to quit buying bonds.
Well, that's exactly the point. I mean, I keep thinking that Powell's waiting for something bad to happen so he has an excuse to pull the plug on tapering.
Yeah.
And that's kind of the sense you have.
And
that's arrogance.
Oh, total. And there's one thing, and I honestly, I've made more mistakes than probably anybody in the business, but I always learn from them. I think, well, the next time, I'll know not to do that.
Yep.
They don't seem to learn very much, but my thing is, if you're still buying $105 billion a month, that's a lot of money. And I don't think
AIG
yeah.
bailout was $85 billion.
Exactly.
And at the time, we were like, wow, that's a huge sum of money. And now it's just $105 billion a month.
So I think that's their problem. And so if they're going to break back and not buy that paper, and let's face it, they've supported this whole machine here.
Oh, gosh.
Everything. And so everybody asked me, so what do you think about the future? And I said, well, the only thing I can tell you is we won't know until two things happen. And you've talked about this. The supply chain gets straightened out. And number two, they take all the buying away in the market. And they're talking about, and I think the supply chain will get straightened out. I don't know about the latter. You probably know more than anybody on that.
Well, that gets us to really, and you've spoken about this, is the role that fiscal policy has played after I call it the flash recession of March and April of 2020.
Right.
But you mentioned a very interesting distortion that's been introduced in the Supplemental Nutrition Assistance Program,
right.
SNAP,
Yeah.
what we used to call food stamps. Walk me through this one more time, because this is amazing. And again, I think it was the day that there was something bad happened in the world that Biden immediately announced that he was going to be increasing this program.
And a lot.
A lot.
And I can't take credit for this. Most of my knowledge I get from somebody else. And I don't mind saying that, by the way. But I had a person in the industry said, hey, let me just tell you what's going on here. And then I started noticing it because food inflation was really going up.
Yeah.
And this person said, well, let me just tell you, here's what happens. I am a very, very poor person that gets a card, and let's say it's built up over time, they drop cash into it. Everybody has a card. You don't have the stamps anymore.
Right.
And let's say they've hit me with 8 or 10,000, and maybe my brother has 8 or 10,000 too. So we sort of cut a deal, and I go sell my card to somebody for 50 cents on the dollar, and now I take that money, and so I can do anything: buy jewelry, I can buy booze, cigarettes, whatever.
Sure.
Okay, but I can't buy food. I'm not buying food anymore.
Right.
So see, nobody in those kinds of systems knows what's going on, and you wonder why food prices keep on going up. Well, if I never had any money in my life, and my biggest year was $15,000 of gross income,
right,
and somebody says, hey, by the way, now you can buy everything now. You can buy lobster, you name it. You
sure.
know what? We'll buy beef tenders, anything you want.
Yep.
Okay.
Filet mignon every night.
Why not?
Well, of course, why not?
And that's just one area. If you took 25 other areas, it's the same thing. Nobody knows what's going on, and that's it.
So I'm going to ask you a question that's going to sound political, but it's not. And how important is Joe Manchin to the United States of America?
I think he's the most important person right now. And we've always in the business, we look at things and we don't try to draw a political line on it and like come down hardcore one way or the other.
Of course.
We're just looking at the facts, okay? And the facts are this. If you don't have somebody like that, and I've listened to him the last couple of days, if you don't have somebody like that has at least some voice of reason, you're going to go off the deep end in a hurry. I mean,
all he's saying is let's just stop and study.
Right.
What some of this stimulus, what some of these unintended consequences have been. That's all he's saying is let's hit the pause button and go look back and see what injecting 42.3% of GDP into directly deposited accounts, what all that cash did.
Well, I think the average person too doesn't understand the fiscal policy and monetary policy. The average person on the street. But in the old days, banks created the money.
Right.
Because you went through the bank loaned the money, and it did something to the economy. But when you start taking the government in Washington and they start firing all this money direct, they go around the banks, okay? And that's why you see loan demand, and I own part of a bank, and I'm in a great bank, but you'll see that go lower, okay?
Right.
And the reason is because they're pushing the money straight to these people.
Yep.
And that's why, and your friend and my friend Lacey Hunt,
yep,
that's what he's always said. Hey, if I ever change stripes, it's because they keep firing that money out there and they go around everybody. And they've done some of that.
Well, yeah, I mean, people don't like to hear it, but I like to say it. I mean, we've taken universal basic income on a test drive and it failed.
Yeah, it did. And it, you know, the old idea that if it's something for nothing, you know, it's never worked.
Mm-hmm.
I mean, in the long run, if it doesn't work, I mean, it may work for a short term, but it doesn't work, and that's what's happened.
So, education in America. Obviously, your undergraduate degree, while you work 40 hours a week, kind of sets you on a path. What about the children who've been left behind?
Yeah.
I mean, what are your views on how to fix education so that all children, no matter what station they're born into, can actually get an education in America?
Well, as you know, I'm a big advocate of fostering children.
Mm-hmm. So talk to me about these two foundations, because I'm fascinated.
Well, I read a book about 26 or 7 years ago by called A Boy Called Ed out of California, and he was a foster child, abused, and it was really touching to me. And I just decided, I said, what I think I'm going to do is whatever I spend at the country club every month, I'm going to give to foster kids too. So I just started doing it without a foundation, and I was having to put out so much money. And so I was going to do a private foundation, and the lawyer said, well, it'll take a year and a half. They don't really trust you, whatever. I said, well, I want to do it anyway. And they sent it to Dallas. This lady called me and said, hey, this is 5 days later. She said, tell you what, if you'll make this a public foundation, a 501c3, you can get a lot more money for these kids. She had to be a foster child. I said, you know what?
Because bureaucracy doesn't work in 5 days.
I said, I'll do that. She turned it around in 2 weeks. Yeah. And so that's how it all got cranking. And what happened?
And where was the first one located?
The first one's south of San Antonio. We have 30-something counties.
My mother was born and raised. She was born in Moore and raised in Pearsall.
Okay, well,
Pearsall High.
We go to Pearsall all the way down to the valley and up to Victoria, but south of Victoria. But my problem with it all was there were a lot of kids, foster kids are under the radar, so you don't get a chance to see what they're doing,
Mm-hmm.
Because they're wards of the state. I can't go mentor one every weekend. So we developed a foundation that did two things. One, we wanted to get things for them that built their self-esteem. And two, we wanted a very quick turnaround. So if we get a request from a caseworker for a child, 48 hours, no matter what it is, okay? So what happens is, if you go to these county welfare boards and things like that, the government agencies, if I wanted a pair of jeans for a kid, 5 months, 4 months. I mean, everybody's talking about, let's do this. They've got money, but they don't know how to do anything with it. So we jumped it, and we went straight to, Child Protective Services and said, we can help you. And we have a great relationship with them, by the way. And so, and then it was so effective.
Those are God's workers.
Yeah. Oh, and they don't make any money.
That's why I'm saying.
It's incredible. So then we decided to do 31 other counties, which is around Austin. And it's the same way. I mean, it's effective. But it's, the gift is mine. I mean, I receive more than probably I receive just in seeing something happen to them.
Of course.
But I get a really good feel for what you're talking about on this educational thing, because I think the biggest problem today is it starts with administrative education, administrations in education. Mm-hmm. And I really believe if you had a simple system where you could go to the teachers of the world and say, I'll tell you what, we're going to cut all this money and all these regulations at the top, and we're going to pay you to teach, okay? And we're going to pay you a little more money to teach, by the way. And we're also going to hire more of you so we can get this situations where if I bring a kid in this classroom, they learn something,
right?
Okay, and we're not.
You're not just a referee.
Yeah, and we're going to try to teach them the skills to move forward. And at the same time, I don't think every child is meant to go to college. I really don't. I think there's a
amen to that.
But you could help them in that way too. You could say, I'll tell you what, through these other courses, through junior high and high school, we're also going to start teaching you. If we feel like you want to go toward a vocational side,
Sure.
then we're going to help you with that too. I think you have to jump the system though, because it's just like the foster care system. There's so much stuff at the top that you can't get down to the kids.
No.
That's one of the problems. But in education, it's steeped in that. And so
the unions are powerful.
yeah. But I think if you really opened up charter schools to say, to particularly underprivileged people, families,
Right,
to
of
say,
course.
tell you what we'll do. We're going to allow you to go to any of these schools out here. We'll give you transportation to get over there, but we want your kids to really be something. That's where you start. And right now, I don't know if you saw this, but about 10 days ago, there's an op-ed in the Wall Street, and the guy was from China, and he was here working on a PhD, and maybe it was Columbia, but somewhere up there. And he said, you know what, my kid's in the 3rd grade here, and so they went the first 2 or 3 grades in China, and he went through all of what they had to do. He said, down here in the 4th grade or whatever it was, I still have it, I can send it to you, but he said, you know what we do every day? They want to know what kind of healthy snack they're bringing to school. And he said by the 3rd day, zero homework. He said, I don't know what to tell you here. He says, how am I going to educate this kid? And so, you know, he's from China. And so I'm thinking to myself, that's the problem with us in China.
Well, I'll tell you, my twins are in Chinese right now, and every day they say, why do we have homework every day? And I'm like, because it's Chinese.
That's right, because it's Chinese.
It's a different type of mindset. But since you raised the subject, where do you think the dollar is one day?
Well, I think right now, you know, it's been stronger recently. It's
Sure.
been so. I think right now.
Oh, I mean, it's ultimate fate.
Oh, the
I'm
ultimate
talking
fate,
about.
right.
I'm talking about whether there are any parallel, because we've got a little bit of an income inequality problem in this country.
Oh, sure. I think the ultimate fate will be like the 40s into the 50s, where you won't realize it, but that buying power just goes away and away and away. By the time you get to the end of it, you're like, you know what? I still have the same amount of money, but I can't buy anything or something like that. And so I think that's ultimately where we're headed. I have to say this, and you know, I've been blessed myself to have monetary wealth. And so I'm a very, very blessed, thankful person. But I will tell you what I think's happened. I think in many, many ways, and I think it's really started on Wall Street, that the big wealth has forgotten about how the game really should go, which is you want everybody to move up. Okay, you want that middle class to stay middle class. You want those people to try to get into that.
You have to have upward mobility.
Right.
I mean, that's the American dream.
Really, we don't have that now. And I watched all the phases. I watched it when I came to business, only one earner family. And you had started inflating, and then all of a sudden you had 2 earner families. And then I saw we went into credit card debt.
Credit cards.
Then we went into
the
home debt.
yuppies.
And we went into home debt, and then we refinanced 4 times. You know, this kept going, and we kept going until you're where you are today, which is these people that don't make any money. People, you know, we have this whole 1% up here. They don't. I'm not certain they even have a clue. I'm not certain they.
Oh,
they'll,
God. I mean,
they'll talk
I
about
have
it.
a friend in West Palm, and just driving around, I'm just like,
Yeah.
do they know how blatant they're being with their wealth?
Yeah, and I'm a capitalist, and I'll tell you,
Sure.
big time. But I'm also a realist, and if you see these countries that, in the end, don't do well,
Kind of like Rome
yeah,
or
you know,
Great Britain.
they end up like a lot of South American countries, a
Mm-hmm.
little bit up here and a lot down here.
Sure.
And in the end, if you look at it, though, this is my point. It gets to the currency.
In the end.
In the end, you might think it's okay now, just because we're the big cheese around, but we might not be 10 years from now, and that's usually what happens. That's what I think will happen, to the dollar.
Interesting. So, if your clients are asking you right now for guidance, what are you telling them?
Well,
Are there any places to hide?
Well, I think where you hide is balance.
Mm-hmm. Okay.
That's where you think you hide. Now, I'll just give you an idea. We're simpletons, I will say. So I'm not like, and I take his stuff too. I'm not like Keith at Hedgeye. That, I mean, our people couldn't do that. Even though I think a lot of it, by the way, and I think
Sure.
I think there's so many different ways. Chris here. There's a lot of ways where people do really well in the business, but you have to align that with the way people feel or
Right.
they can understand. Well, for us, we're pretty simpletons because a lot of our people had a business. They're simple, and they think, I know how this works. So we have like 3 strategies. We have a really conservative strategy, never lost money. We have a strategy in the middle called high income that is designed to beat the bond market, which it always does, but it doesn't own any bonds. Interesting enough, it's all cash flow though.
Mm-hmm.
And then we have a stock strategy. But in what we do with people that have, and because I tell people today that sell a company, oh, by the way, man, you picked the greatest time in the world to sell your company. However, you picked the worst time to start investing.
Haha.
So that's 2 things. And they always say, yeah, but I got to do something. Then I ask this question. So let me ask you, did you get 50% or 100% more for your company than you really thought it was worth? Yeah, I did. So I said, but then what's wrong with just kind of hanging loose for 2 or 3 or 4 years?
Sure.
You got twice as much you thought you'd get anyway.
Right.
So why go out and have to burn it up? So what my advice though to people is, the reason you have to have balance is this. If we don't know what the future holds, and we don't know, okay, then we're going to be in a situation where our middle strategy produces cash flow, and you need that to live on. And we want a cash flow stream that's coming no matter what. We have so many things in there. We have convertibles and REITs and pipelines and energy and metals, and we have fertilizer, all sorts of things. But everything pays a cash flow stream.
Sure.
And that's what you have to have today.
Well, you can't fudge cash flows and you can't fudge revenues.
Exactly.
So there's 2 things that you can't do.
And I know people look at that and say, well, since 1992, that's been sort of a 5 3/4, 6%er on average. And I said, yeah, it has, but you got to have it. Okay.
That beats 0. It beats what you're going to go get, parking it in a bank.
Yeah, and we've always had in our conservative portfolios, we've always, and that probably comes from me being in around the 70s and early 80s, but we've always kept everything within about 60 months, generally.
Mm-hmm.
And we had about 15%, 20% that we really had long paper in, but we didn't buy any after 19 or so.
Mm-hmm.
So a lot of that's is running off. And then we have a stock portfolio that is it's not exchange traded funds or indexes, they're companies. And we try to buy companies that we think can make 15% or so over the next 5 years annually. And we use we discount it and try to buy at a discounted number if we can, okay?
Fundamental analysis.
Exactly. Well, you know how it is then.
My gosh.
Yeah, I know.
Portfolio management 101. What an antiquated thought.
Well, and to be able, and I know you can appreciate this, but so many people today, in the business, can't read a balance sheet and an income statement.
And that's why financial advisor, as you said earlier, is an oxymoron.
Yeah. Well, I will tell you, most commercial bankers can read a balance sheet and an income statement better than I bet half of the investment community everywhere. Because what they do is they buy, okay, I'm going to buy the ARC fund, okay. They don't know what's in it. They don't know what the companies do. They have no idea if they're making any money, but it looks good to me, okay? And they don't do that now. So what we do is we own things. We don't, and I'll tell you where it comes in handy. When times go bad, if you only own all these one-liners and people walk in, what are you going to tell them? Well, yeah, they're all down. But if I can show somebody, hey, let me tell you what you own here, okay? This company that we really love, okay, and we bought it at this level, but now we can buy it 25% cheaper. We're going to buy some more of it.
Yeah.
Okay?
If it's got a
Or
strong balance sheet,
I'll
it's got
give
free cash flow, and it's got true revenues, and all those things.
I'll tell you about, for example, the high income account, and you can remember this well. March of 09. In that first quarter, we found things that were yielding in the high income portfolio. They were yielding 14, 16, 18 points.
What a nice thought.
And we had liquidity, so we put it in. You imagine that's why that was one of the 3 best years we ever had, because we had liquidity. And you could, but what I'm saying is I could go to somebody and say, now look, okay, I'm going to show you this business, okay, right here. This is how much debt they have. This is how much cash flow they have. And I know it's getting hammered in the market, but I want you to look at the value on it, okay?
Yep.
And then I start comparing it to a piece of income producing real estate, because they can understand real estate. The average person can understand real estate. They can say, so that's a 8 or 9% cash on that piece of property, and yeah, okay. Well, we get in that mode with them, and so all of a sudden they're like, all right, I'm good. And the other side of it is we always have this piece over here. That's what I call the buffer.
Yeah, the cushion.
So that you have to, in bad times, you have to go back and say, now's the time.
So there's one area that has exploded.
Uh-huh.
I keep using that word, exploded, and that's private equity.
Oh, yeah.
What effect has private equity had on price discovery? Because it's its own beast. I mean, I don't think private equity would be as big as it is today if it wasn't for central bank policy.
Right. Yeah. Well, I think, I'll tell you this, and I'm not telling you anything because you know all this, but Wall Street is the genius at dreaming up anything that works, okay, and they can sell, all right? And I've watched them through all of these things, okay? They had the big 50 that when I first came in the business. Then, if you remember, they went into limited partnerships. They limited partner everything, real estate. That was for RTC.
Yep.
And then they came along and we dropped the commissions, and so you left the stockbrokers and the loot. They're out in the cold now. So we're going to come in and we're going to start, doing it for a fee, and we're going to put it over here with this person. Then that got too proliferated, and then so they said, well, let's go start buying real estate, private businesses, everything we can think of, and we're going to do it in private equity, okay? And here's how we're going to do it.
Everybody's got to have it.
We're going to charge you an annual fee. We're going to charge you a fee when we go buy that, whatever it is. We're going to charge you a fee to take care of it. We're going to charge you a fee when we sell it, and then we're going to split with you after the profit, okay? Then we're going to show you. So that's how that all came along. And so what happened is, I can't tell you how many people, women and men, that I met that are, say, 40 or 45. What are you doing? Well, so-and-so, we started a private equity fund. And how long have you been doing it? About 5 years. How's it going? Oh, we are killing them. Always, I have a second question, though, Danielle. Have you sold anything yet?
Uh-huh.
No, because we have a 7 to 8, 9 year time frame we're looking at. I said, yeah, but I said, have you looked at the numbers? If you have to get liquid here, okay, blah, 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 but you can walk through that thing. And so when I go to investors and everything that have talking about, hey, I'm looking at this private equity deal, and I'd say, okay, one big mistake you make if you buy a private company is you need to know the people that owned it. Like if we invest in a private company, which I do and some other people do, it's not that we offer it to our investors very much, but you know what we key on? The people.
Sure, it's like a community banker and making a loan in the olden days.
Right.
They knew
the people.
They knew them.
You make a great Fed head because you know the deal. you know all the stuff. See, we don't have anybody like that. But what happens is that to me is what's going to print the private equity. They bid up everything. They bid up, and the piece you wrote yesterday was fabulous about how much powder was out there to go in to buy real estate.
Just for commercial real estate.
Just that one thing.
Just that one area.
But we see it though in private businesses. They'll come along in a company that we think should sell for, say, 6 times pre-tax. They're paying 14 times. So, they'll come around and they'll say, and I have a question for them always, and that is, so what's the end game here? Like, where are you going? How are you going to turn that? So I'm paying 14 or 15 times pre-tax, let's say. And by the way, 2 years from now, the owner who really is the brains is gone.
Oh, yeah.
So, and see, they do okay during these kinds of periods because money's loose, all that kind of thing.
Sure.
But when you finally get to the end, and that's probably maybe 5, 6, 7, 8 years from now, and everybody has to sell to liquidate, then we're going to find out. And that's the problem.
Well, okay. So in the next 5 to 7 years, can we go back and end with why you think UT football is going to get better, please?
Well, I think,
Poor long
yeah,
words.
I think, and I have to do this for my wife because she's at UT.
Because I was going to say, you're Texas.
Yeah, I didn't go to UT, but I have to do that for her.
Do you root for?
I do. I root for Texas too, but I root for my alma mater too. But you know,
Wait. What do you say? Get your guns up?
no, I don't do that very much. I just say, yeah, they don't win much in the way of football. I love them. Don't get me wrong, but I want them to. The thing about it is that I sort of have to do that. I'm married, so I have to do that. But they have a great coach, and I think people realize he's got a really great offensive mind. But if you look, I could give you this information. But if you look,
this is the most important subject that we've covered today. So I really want to know.
The last 3 years of classes that they recruited, which was basically, I'd say 4 years, 18, 19, 20, and 21. If you could look in there and see how many players they lost, they either left, went to pro, went to another team. He's operating with not even 50% of what he should have.
Right.
And so
That's
he's
why
having
they don't have an offensive or defensive line.
We got a coaching position for you. So
even I can tell they don't have either
right.
line.
So if you give him time, he's a smart guy. And I really think one of the things I like about him is that I love people that have overcome, like you, and like I have you, and all the other people you know out there. And he's done that, and I like that about him. And so that just means that he'll have the ability to really think a little bigger than I need to win the next game. I want to look at a big picture. We'll see, but I think he'll do well.
So one last question is, should OU and UT have joined the SEC?
Well,
these are really important matters, everybody.
Probably out of my pay grade, but I think so. And from this respect, we're getting, this whole game is becoming a big business.
Oh, it's getting gamed.
Yeah,
the game is getting gamed.
And you look at the amounts they paid these coaches just this year in these last 5 or 6 that went up. So I think they did in this respect that the smaller schools are going to keep on losing revenue, and the bigger schools can keep on gaining it. And I know it probably feels like they've been slighted, the other schools, but I don't think they had a lot of choice because if they're going to really recruit, they got to get in a big area, either Big Ten or Southeastern Conference. Not so much the Pac-12, but I think the Pac-12 will come around eventually too. They've been good in the past, but
well, I will say this much. So this is my theory.
Yeah.
If you're a boy in Texas now and you're some freshman or sophomore, I actually know an 8th grader who was offered something at Mississippi State or somewhere.
Yeah.
8th grader.
Well,
they're getting very aggressive. But if you have the choice of going to Texas and immediately playing because we don't have enough players, or going to OU, or going to A&M, or going to someplace where you're going to sit on the bench.
Right.
See, that's what I think the secret sauce is. I think we're going to be able to get boys who want to play football.
Well, you took the words out of my mouth. If I'm a really good defensive lineman or offensive lineman, and I'm not speaking for the coach, but I'm sure he's saying something like that, like, hey, you know what? You won't have to be here till you're a junior. How about the second game?
Sure. This is good. This is great. Okay. You've made my day. When I come back in a year, we're going to have a winning season, right? If we sit down again.
I bet Texas does in a year. Yeah.
Okay. I'm gonna hold you to that.
Yeah.
I'll tell you what. I'll buy you dinner if they don't. You buy me dinner if they do.
Oh, okay. Well, all right, that works okay.
I
I
just
think
did
you
that
reversed
backwards.
it, though.
I reversed it.
You should be buying me. I should be buying you dinner if they don't.
You buy me dinner
Right.
if they don't. Okay. And I'll
Okay.
buy you dinner if they do.
Well,
Some good barbecue.
You're a great. You're really a great ambassador for University of Texas and going to school and all of that. I know people know who you are.
Well, I'm happy to be back here in Austin. I'm happy to have spoken with you. I'm happy to put you on the spot for once. But I look forward to the next time that you're interviewing me as well. But thank you for spending so much time this afternoon.
Well,
I really appreciate it.
I do appreciate it. I have to tell you, I've never told anybody the things I told you today. But it's okay. I'm all right with it. But it's interesting. I never talk about that kind of thing because it's really never about me. It's always about other people.
Well, children have to have a reason to dream. That's what I say.
Yeah.
They have to know that they can come from anywhere and accomplish something. And we've
Yeah.
got to get back to that in this country. And I
Yeah.
feel strongly about
Well,
that.
thanks for having me.
Thank you. Appreciate it.
All right.
It's fun to hear people's true stories. And Ted gave us his all, and I'm so pleased. I hope you enjoyed it as well. I will say I got the same level of depth out of somebody else you might be interested in, and that's Grant Williams, who's also always the one doing the interviewing. So if you happen to miss that episode of Down the Middle, go back and watch it, and you'll appreciate who Grant is, as well as you now appreciate who Ted is. So until next time, this is Danielle DiMartino Booth with Down the Middle. Thank you.